Morning. I'm just going to wait a moment while people continue to join. Welcome and thank you for joining us. My name's Michelle Waitley. I'm the Specialised Business Bank Executive for Commercial Real Estate here at NAB. Before we begin today, I'd like to acknowledge the traditional owners of the lands on which we meet. I'd like to acknowledge the Boonwurrung people of the Kulin Nation as the traditional custodians of the land on which I'm joining you from in Melbourne. And I'd like to pay my respects to all elders past, present and emerging. Welcome to our last quarterly webinar in our property market series for 2023. In our first webinar this year, we provided an update on the economic environment, and CBRE joined us to discuss the potential impacts on the commercial real estate market in 2023. And 2023 has certainly been an interesting year. We've seen more interest rate rises, which has impacted serviceability and borrowing capacity. There's been a further slowdown in acquisition activity. There's been some reduction in asset values, although not as much as we might have thought as rental growth has flowed through. And there has been a slowdown in the residential development activity amid an uncertain building environment and feasibility pressures. And yet we have a housing shortage and a rental crisis. We were joined during the year by M3 Valuers and WT Partnership to discuss the development market. And we also reviewed the office market and impacts of ESG with JLL. We thought we'd end the year with a review of 2023 and the outlook for 2024 from both an economic and property market perspective. And we'll also discuss some trends and themes to watch for in 2024. Joining us again is Taylor Nugent, who is a senior economist within the Global Markets Research team here at NAB. And he was previously an economist and financial markets analyst at the Reserve Bank. Taylor will start by setting the scene with an economic review and update. And we're also really pleased to be joined by Benjamin Martin Henry. Ben is the head of real assets research for the Pacific region at MSCI and is responsible for producing thought leadership covering both the major property sectors and newly emerging ones. Ben has over 15 years experience in Australia and the UK across investment analysis, research, strategy and product development in the property sector. And he's held some senior roles with IPD, CBRE, where he was head of capital markets, office and BTR within CBRE research, and RCA as head of analytics. So welcome to Taylor and Ben. The property sector remains critically important to our Australian economy. And as Australia's largest business bank, I want to assure you that we are absolutely open for business and we're here to support our customers to continue to grow, but also to work through any challenges that you might be facing. And we continue to work with you as your finance partners looking into 2024. We'll have time for questions after the formal presentations. Please use the Q&A function at the bottom of your screen and we'll get to as many as possible. And we're also recording this session and we'll share it with you afterwards. On that note, I'm going to hand over to our first speaker, Taylor.
Thank you very much, Michelle. Hello, everybody. It's a pleasure to be here. So what I plan to do today is just give kind of a high-level update of how we're making sense of the world at the moment and how we see things playing out as we look into 2024 and even further along in the outlook as well. I think what's interesting now when we look back across the past 3 years, it's been obviously a very interesting time. There's been a sequence of shocks and they've had very large economic implications, and policymakers have really been playing catch up in order to try and get on top of the inflationary implications of this very robust recovery out of the COVID recession that we saw. I think where we are now is that Over the last 12 months or so, it's been less a new shock. It's been less some change in the inflation process that meant the outlook is different. It's more been about marking progress in kind of getting on top of the challenges that are known. And so I think where we are today, we're seeing resilience in the global economy, Australia especially so, and that's meaning that maybe inflation is falling back a little bit less quickly than policymakers had earlier hoped. But when we think about a lot of the challenges, they're largely similar themes, and we're just kind of working through and marking progress on those themes. So at a high level, I think when we look forward, one of the really interesting things when we look at this situation from Australia is that we're increasingly out of sync on the policy cycle. We saw inflation pick up later in Australia, and we've seen inflation be more resilient. And we've also had a central bank in the RBA that's been trying to manage this cycle less assertively than other central banks, I guess is one way to put it. So they've been more reluctant to increase interest rates. They've been paused at a lower rate than many other advanced economies. And they've been trying to manage this cycle without moving rates as deep into restrictive territory. The aims there were to maintain as many of the gains in the labour market as possible. Those are admirable gains. I think that we're not necessarily knocked off that narrow path that the RBA has been communicating. But as I'll touch on in a bit more detail through this presentation, when we look at where we are in the Australian economic backdrop at the moment with the extensive inflation pressures that we're seeing, even as we are seeing some pass-through of restrictive policy rates that is affecting the outlook, we are seeing cooling in the inflation rate. When we look across other central banks, the risks are still to more rate increases from the RBA, whereas elsewhere, investors are increasingly focused on when and how much will central banks be cutting. And so we are a bit out of cycle at this stage in Australia. On the left-hand chart here as well, you can see that while the RBA has been trying to manage this cycle a little bit differently, a lot of the communication earlier in this tightening cycle was that the Australian backdrop was different. There were, less energy cost pass through, wages growth was slower, a range of things they were pointing to for why the domestic inflation backdrop wasn't as entrenched. And what we've seen is that the peak in inflation in Australia was broadly comparable to a lot of other advanced economies, and progress so far on disinflation has been less pronounced and in some places as well. And so that kind of speaks to a lot of the challenge of disinflation. Australia is still ahead, and we've made less progress so far. When we think about where we are now, again, kind of looking across countries as well, on the left there, you can see what businesses are saying their business conditions are like at the moment. In Australia, despite the headwinds that are well known, despite business confidence and business conditions being well off their peaks during the COVID recovery, they're still at reasonably healthy levels. They're still above their long run average. Part of that is, the support for activity that's coming from population growth, even as per capita spending has slowed, which I'll touch on a bit more in a moment. But, a lot of it is just still, we're in a capacity constrained environment where, demand is not a constraint on business activity at the moment. That stands in contrast to consumer confidence, which again, is a common across advanced economies, is that consumers are very gloomy, and that isn't fully reflected in their actual spending behavior. And so I think the way to make sense of this disconnect is that consumers do not like inflation. And while they're communicating that they're gloomy, they're communicating that their family finances are stretched. When you actually look at their spending behavior, it's been much, much more resilient than you would expect given the softness in some of these surveys. But all of that isn't to say that, policy isn't working. We have seen activity slow, which I'll get to a little bit more. While labour markets are still tight, they have cooled a little bit from where they were through 2022, and we expect them to continue to ease looking forward. But you'll see in those forecasts there, both our forecasts, which are for a slightly faster uptick in the unemployment rate, but the unemployment rate getting to kind of similar levels to official forecasters are projecting. We still don't think that the unemployment rate needs to go back to where it was prior to the pandemic in order to ease some of these capacity constraints and labour shortage pressures that we're seeing. And so, we're still kind of on that path to managing this disinflation while still seeing, better labour market outcomes for workers than we saw in that pre-pandemic period. There is obviously a lot of uncertainty about how quickly the labour market will loosen looking forward in response to the slowdown in activity that we've seen. But really the key task here and kind of the necessity for policymakers, why the RBA is still communicating that some further tightening may be needed, even as they're seeing some slowdown in activity, is that inflation is much too high and it needs to come down. And so I think what we've seen when we look back over the last 6 months or so is the RBA in August, they were forecasting a very, very rapid disinflation. We had some positive data in the second quarter of this year, and they really are kind of underestimated the persistence of this domestically driven inflation problem. And we saw that come through in that upward revision to their forecast in November, and them acting on that long held tightening bias and delivering that other hike after 4 months on hold in November. We think now when we look at their forecast, the risks are not as obviously skewed. We do think inflation will be coming down, but you can see there we're expecting it to be above the RBA's 2 to 3% target until 2025 and fall back only just within the top of that target through 2025. And so there's very little room on the upside for further bad news on inflation in the RBA's context. And I think that's very important when we think about the risks around rates looking forward. But I mentioned there that, policy, we do think it's at a level that is restrictive. We think that the RBA probably needs to do one more hike to get to a level that weighs on activity enough to get back into balance and see inflation cool as quickly as they need to see it cool. But we are seeing, that there is pass through, households are being squeezed, and we can see on that right-hand chart there that disposable income growth has been going backwards in real terms. So a big part of this is that elevated inflation is eating into income growth. But another part of it is that we have bracket creep, we have high employment, high hours growth. All of that is boosting labour income. That's passing through bracket creep into a higher income tax take. And we're also seeing it through interest payments being increased, and that cash flow channel biting through mortgages is weighing on disposable income as well. And so all of these things are working to put pressure on budgets and pass through into slower spending as well. Where we are now is that households in aggregate are maintaining consumption out of, slightly saving a smaller proportion of their income than they did prior to the pandemic. Up until kind of early into this year, it was a case in which income growth was keeping up and sustaining the spending growth that we were seeing. But now we are seeing this kind of nominal income squeeze coming through and passing through into a slowdown in consumption growth. One big offset to that in the Australian context is the rapid recovery in population that we've seen. And so on the left-hand chart there, you can see just how quickly population growth is growing in Australia. So population growth is running at about 2.9%. In annual terms, that's equivalent to over 600,000 people being added to that 15 plus population in the past 12 months. And so this is very, very rapid. And that recovery in the size of the population is supporting consumption growth as well. So when we look at the aggregates, consumption growth has been positive, but on a per capita basis, it has been moving backwards over the last 3 quarters. And so when we look forward, we think that consumption growth will remain subdued, and that will really drive a lot of the variation that we see in aggregate growth outcomes over the next couple of years. And we see growth below trend somewhere in the range of 1 to 1.5% over 2024, and then picking up a little bit through 2025. Looking forward, a key thing when we look at these very, very elevated population growth numbers, the implications that has not just for the level of spending, but also for housing markets, for labour markets, for everything else, is that we don't see this level of population growth as sustainable. This isn't the product of some policy change that means that we're going to be running at these kind of growth rates going forward. This is, you can see in that top chart there, is a process of catch up for that period of pause migration we had through the pandemic. And it's a period where especially students and working holiday makers, the population of those visa holders in Australia is being rebuilt and being rebuilt rapidly. That process is nearing its end. And so we do expect population growth to be moderating back towards that more normal 1.5 to 1.75% level over the next couple of years. And when we think about our forecast, we expect some handover between some of the squeeze on per capita consumption to ease, but some of that tailwind from just more people to be offset by a recovery in per capita consumption growth as well. The other thing to remember here is, although we are seeing declines in per capita consumption over the last little while, is we shouldn't forget that this is from a position of strength. When we think about the headwinds that the economy is facing into over the next couple of years, the reason that we're facing these challenges is because of just how complete, and in fact more than complete, that recovery from the COVID impacts was. And so it's from a position of strength where consumption per capita was well above where it would have been if we continued to grow at trends. And it was from a position that has proven unsustainable given how much inflation we were seeing. So those capacity constraints will be easing in response to some of this slowdown in spending. And when we think about, is this a recession? Is this a negative outcome? I think it's worth remembering that we're seeing this slowdown from a level of activity that was too strong for the supply side of the economy to keep up, rather than a fully utilized economy moving to a period where there is a lot of unused capacity. And so I think that's important context when we're thinking about some of these numbers that in a normal context would look like a fairly negative outlook. This is moving back towards balance rather than moving to a situation which there's a lot of underutilized resources in the backdrop. The other impact of population growth, obviously, is through the housing market. This is certainly a challenge to the RBA's disinflation task. This is showing up through rents inflation. We see rental markets that are very, very tight. I think, again, I mentioned there that we don't expect population growth at these sorts of levels to be sustained. I think the flip side of that is that it's not necessarily the case that some of these extreme rent increases that we're seeing at the moment will be sustained as well. We certainly don't think that the housing market is going to suddenly switch to an excess supply environment. But I certainly do think that some of this pressure that we're seeing through residential rents over the last 12 to 24 months is a frictional pressure. You had a situation in which any easing in housing scarcity during that period where we had people moving out of inner cities, we had that temporary visa holder population not here. That housing supply was absorbed by people moving into smaller household sizes, getting extra space, getting that spare bedroom or that home office. And we've seen that as prices are moving higher, we've had this frictional challenge of absorbing this rapid population growth at the same time as people have been trying to hold on to this extra housing that they've been consuming through the pandemic period. And so, that's driving a lot of these pressures at the moment. What that means is that while we think there is some hope for, the pace of rents growth to start to slow going forward, that's not going to be much help for, the inflation problem in the next kind of 12 months at the very least. It will be late 2024 at the earliest where we start to see that reflected in cooling rents prices in the inflation basket. And that's because the average rents price people pay, obviously, that reflects market rents with a very long lag because of, 12-month leases being the standard. And so these pressures, there is some hope there. It's not all doom and gloom that these kind of rapid increases in prices will go on forever. But that isn't much help in the near term for the inflation challenge. So where can we expect some moderation in inflation? I think here, this chart, there's a lot of colors going on here, but I think the key point is just it illustrates that sequence of inflation drivers that we've seen. In the orange bars, you can see goods prices. These are kind of consumer durable goods. We saw those pick up early in the inflation spike. That was reflected across other advanced economies as well. You had that confluence of constrained supply chains with very elevated consumer goods demand during the pandemic when services consumption opportunities were constrained. That showed up in very rapid increases in goods prices. And that's an area of the basket where you didn't see much inflation in that earlier period. What that's doing, that's now moderating. So we've seen global supply chains become less constrained. We've seen some moderation in global goods demand as well. All of that's feeding through into less cost pressures through that goods part of the basket. And a lot of the disinflation that we've seen so far is that, that goods side of the consumer basket, we're not seeing much inflation in there at the moment. That's largely normalized. And we expect that to kind of continue and to be some help to further progress on disinflation. The other part is housing construction costs. So they were obviously very elevated during the pandemic. We had home builder pulling forward some demand. We had that demand for space I talked about in the rental context, also contributing to home building demand. That has also now started to slow. And so what I'm hearing from construction businesses that I've spoken to, what we're picking up in our business survey, is that while prices aren't falling there, a lot of the cost pressures have really pivoted from those input cost pressures towards labour cost pressures, reflecting more of that kind of domestic tightness in the labour market. And that has also been a big help for disinflation. What we haven't seen much of yet is any slowdown in that domestically driven services part of the inflation basket. And that's something that the RBA Governor Bullock spoke about last week as well. That part of the basket is something that central banks are watching closely, and the RBA is no exception to that, because that's something that is, better reflective of domestic pressures, domestic. It's less about imported inflation. It's more driven by the domestic economy. And however you cut the basket in order to try and get some indication of what these domestically driven pressures are, they're very elevated, running at kind of 6 to 7% over the last year. And on a quarterly basis, they haven't really shown much slowing yet either. And so that part of the disinflation process is still very much ahead. Some of that lower hanging fruit is through goods, through housing construction costs slowing down. That's what we've already seen so far. This part is likely to be a slower process. And so that's why, our inflation forecasts extend out for above 3% inflation for close to a couple of years yet. But we do think that alongside that slowing in activity that we forecast, with some of the extreme tightness of the labour market continue to ease, that this inflation will be slowing over that period as well, back towards where the RBA would like to see it. On the labour market, just quickly, I think, one of the key things in Australia, one of the reasons why the RBA has been optimistic that they might be able to manage this cycle with a less restrictive policy rate than some other countries, is that wages growth hasn't picked up to the same extent. But the problem is, productivity has been poor in Australia. Productivity is pretty poorly measured quarter to quarter. It's very hard to set policy in real time based on that data. But what we have seen is that a lot of the cost pressures, a lot of the labour cost pressures that are being reflected through the inflation that we're seeing is more to do with hours worked increasing much more rapidly than activity is. And so that's being reflected in lower output per hour and lower labour costs for the amount of output being produced. And a big part of that is that this has been a very employment-rich recovery. Sustaining labour incomes is an increase in hours worked and a very rapid increase in employment, even faster than the strength in activity that we've seen. And so that's keeping that labour cost pressure high. It's also been supporting incomes and explaining some of the resilience that we've seen in consumption. That's not something that we see persisting either. We've already seen hours growth slowing a little bit. And so that should be coming back into balance as well. And what that means is that, the RBA is assuming in their forecast that productivity will return to around what it was prior to the pandemic, which is not, an especially aspirational goal. It was fairly sluggish then as well, but it's been declining over the last, 12 to 18 months. And so what that means is that we do think that there is some scope for some of those labour cost pressures to be easing, even without a material slowdown in wages growth. And that's obviously very important for the disinflation process. But again, the RBA doesn't have much room for upside. It's a reasonable assumption to make in our view, but there are still risks there that this domestic inflation pressure will be more persistent than they hope. So just to conclude, making sense of all of this backdrop, we've seen a clear sequence of inflation drivers, those internationally driven, those common inflation pressures through energy, through goods, in the Australian context through housing. A lot of those are starting to moderate, and we can expect them to continue to moderate, and that is helping the disinflation, explaining a lot of the disinflation we've seen so far. The challenge from here is that domestically driven inflation problem, and on our forecast, we do see the unemployment rate moving higher gradually. We see activity growing below trend, and all of those will be bringing the demand and supply in the economy back into balance, and we see inflation coming back down broadly similar to the RBA expects in their latest forecast, given that they've revised up their forecast recently. Importantly, though, those recent RBA forecasts, our forecasts as well, are implicit on a little bit more tightening from here. We think that the RBA will deliver that further tightening, and we expect an increase from the RBA in February. More broadly, given that the RBA has kind of shown their stripes as a reluctant hiker through this cycle, they're trying to do as little as possible to manage the risks. We think that given the level of the cash rate where it is at the moment, well, we think it probably is enough to see gradual progress over the next couple of years. We don't expect the RBA to be starting a cutting cycle particularly quickly. And so we don't expect the first cut until November 2024. And we have a cutting cycle on our forecasts absent some other shock, this is obviously a lot of uncertainty when we're looking this far out, but we have that proceeding fairly slowly and normalizing back to a cash rate in the low threes only by the end of 2025, early 2026. And so given the way that the RBA has been managing the cycle, given the resilience that we're seeing, we think that policy rates will have to stay in this kind of moderately restrictive territory for some time in order to be comfortable with that inflation is kind of moving sustainably back to where the RBA needs to see it. So with that, I'll finish up there. Look forward to any questions at the end. But before that, I'll pass over to Ben.
Thanks, Taylor. Good morning, everyone. That was pretty sobering there, Taylor. And I suspect that some of these commercial real estate numbers that I'm about to present will be quite sobering for some people as well. So I'll jump right in. But I did want to say thank you to NAB for having me, of course. So Australia's commercial property market, it really has continued its slowdown into the end of the year. And these are Q3 numbers, which are finalised numbers, but I'll speak to some more recent numbers in a little later. Transaction volumes, they're around 9.3 billion, which is down around 60% compared to last year. But I guess importantly, we've come to that point in our market where we start referring to everything as being the worst since the GFC, unfortunately, which was our last major economic crisis. COVID obviously had some financial impacts, but that was more of a health crisis. Yeah, the quarterly results they're even below Q3 2020, which is a little bit concerning because Q3 2020 was the height of COVID and deal making was significantly curtailed due to border restrictions, obviously induced by COVID-19. So that is a little bit concerning. Now volumes for the year are around 30 billion, and they're down around a third compared to those 5-year averages. That's including 2020. So there are a lot of concerns out there, and we definitely have reached the point in the cycle where the boom has come to a bit of an end. Now, what I'm showing in these charts is I'm just tracking running volumes and counts for the market, and yes, 2023 is significantly off the pace. It's also appearing less and less likely that the market will receive its kind of customary surge of volumes in the fourth quarter. And over the last decade or so, the fourth quarter has on average accounted for it's around 35%, 36% of all investment volume in any given year. But with only about $3.5 billion of transactions in the pipeline, which I've actually included in these charts just to see if there is likely to be any improvement. 2023 kind of looks increasingly likely to go out with not with a bang, but a bit of a whimper. We've only seen so far this quarter as well around $3.5 billion worth of transactions, which is again very, very slow. And you can really see that in these lines, particularly on the right-hand side in that deal count, that tapering off towards the end of 2023. And it's a long way away from those volumes you saw in 2021 and 2022. Looking at the actual dollar amount, there has been a slight uptick. That line is a little bit sharper than the deal count line. And it's not wholly surprising, to be honest, because there does appear to be a bit more interest in the market. There has been a substantial increase in the number of assets put on the market in the last few weeks, such as ISPT offloading 4 retail assets and Vicinity buying back Chatswood Chase, for example. And whilst these assets are unlikely to settle this year, which is what most of our numbers are based on, settled transactions, it does show that activity has been picking up of late, which is good to see. And in fact, it's retail that seems to be the flavour of the quarter, and it's something I'll touch on a bit later. But just where are people actually buying? Now, unsurprisingly, the activity that we have seen so far this year is most centred in our 2 main markets here in Australia, of course, Sydney and Melbourne, which have accounted for around 60% of transactions this year, which is actually pretty much bang on long-term trends, which is good. Now, for the first half of the year, Sydney and Melbourne accounted for around 75% of all transactions. And I think about 80% of those were in Sydney as well. And I did raise that as a bit of a slight concern earlier in the year because we don't want investors to be so heavily concentrated in just 2 markets. It really then speaks to the fact that they are only looking at core assets, this whole flight to quality scenario that everyone talks about. And that really does speak to that they're only focusing on those main markets. But it is good to see then that investors are now acquiring across the country, notably in Brisbane and Perth. Brisbane numbers still look pretty down compared to last year, but recently has been a bit of an uptick. And these two markets, they're kind of bucking that office rental decline trend and showing a little bit of growth. And again, any reversal of trend is good to see at the moment. And of course, it's nice to see the nation's capital showing some leadership, being the only major market to record an increase in volumes compared to last year, up around 150% at sort of 1.3 billion, which is mostly due to a couple of large offices transacting. Now, speaking of office, I think everybody talks ad nauseum about offices for obvious reasons. So what are these investors actually acquiring? Well, it's not actually office. And as 2023 has progressed, the contrasting trajectories of the core sector has become increasingly evident. Now, people are still acquiring retail, and there does seem to be a bit of an uptick recently, but the volumes are significantly down compared to last year. And of course, everyone remains highly skeptical about the office sector. Now, throughout all this uncertainty, the industrial sector remains the most resilient in this turbulent market. No real surprise there, but it too has seen a slowdown in transactions over the last year. They have markedly deteriorated in the last 12 months. I think they totaled around 3 billion in Q3, which is around a decline of about 50% compared to last year. So it takes the year's total to around 10 billion, which is a decrease of 50% compared to the same period last year. Now, 10 billion is actually quite a good number for industrial compared to long-term averages. Now, the thing with industrial is we had a record year in 2020 for industrial transaction volumes. 2021 then doubled that record year. So there's no way 2022 was going to hit those levels, and there's no way 2023 was going to hit those levels because investors aren't likely to dispose of those assets they acquired in 2020. So there just isn't enough stock around to actually sell. And also pricing did get very, very toppy. And just to further illustrate how popular industrial has been over the last couple of years, in 2021 and 2022, there was $60 billion worth of transactions. That's the same as the previous 4 years combined. So there is a significant amount of interest in the industrial sector, and there still is a fair amount of interest as well. Now, going back to retail, I'll touch upon office a little bit later, but going back to retail, there are some interesting patterns emerging in the retail space. And I always say this, I often find that people have this big helicopter view of retail where it's just big shopping centers and they're not performing particularly well. And you know, that might be true, but there are a lot of really good performing retail asset classes over the last few years, such as large format retail, big box and neighborhood shopping centers. Big box here is mostly Bunnings in Australia. They have been performing extremely well, again, for obvious reasons. When we were locked down, everybody had to buy, you know, office chairs and desks, and therefore they went to large format retail spaces, you know, these homemaker centers. And if they had to do some remodeling, I know those homeowner grants given by the government to get the economy moving again. So you go to Bunnings and you buy up, you know, furniture and wood and desks and all kinds of weird and wonderful things from Bunnings. So Bunnings did extremely well. And of course, if you're locked down in your local LGA, you may not have been able to go to those larger shopping centres to do your grocery shopping, so you frequented the neighbourhood shopping centres. So these assets saw a significant increase in value and indeed pricing. So what I'm looking at here is just looking at the price change over the last 5 years and also the year-on-year change in transaction volumes. So to me, it comes as no real surprise that we've seen a slowdown in the first three there, the large format retail, the big box and neighbourhood shopping centres. Pricing got very toppy. We saw big box increase by sort of 35-40% over the last 5 years, large format retail around 20% and neighbourhoods as well. We also saw a significant amount of investment in those sectors. And what that meant, of course, was there's less stock to transact. So again, no real surprise that we've started to see a bit of a slowdown. Now, conversely, on the other side, regional centres, subbies and those large shopping centres haven't seen a lot of activity in the last few years, and they have seen significant value declines in the last few years as well, particularly the larger shopping centres, again, for obvious reasons. When COVID struck, non-essential retail services were shut down, of course. So those larger shopping centres did start to struggle. What that meant was prices came down. According to one of our indices, retail values on the whole fell around 20% in 2020, and they've only recouped around 2 or 3 percentage points of this up until the latest downturn. So what that has meant is that prices for these centres became pretty good value. So we've seen a substantial increase in volumes in the major regional centres, for example. As those pricing levels got so low, suddenly they look like really good value. So we've seen a lot of these transact in the last 12 months or so. I suspect this may continue into next year, as obviously population growth is really going to help drive retail spending. And population growth is also going to drive fast food. Now, this is a bit of a random one for me. It was about a month ago, I was sitting in a McDonald's on a golf trip, and there was a sign there saying that this table is reserved for McVIPs, Faye and Dot. Well done to Faye and Dot. Now, I did wonder how you actually get to be a McVIP. I assume buying a lot of fast food. And this Macca's had actually sold in the last 12 months. So I thought I'd just have a quick look and see what transaction volumes of fast food franchises have been doing, because it's not something I talk about very often. And there has been an absolute surge in activity over the last couple of years. No real surprise that volumes are down this year. Everything is down this year. But relatively speaking, volumes haven't fallen nearly as much as other sectors. So yeah, there's been just, like I said, there's massive surge in investment in the likes of Red Rooster to Domino's to GYG and McDonald's. And some of these are on very, very tight yields. The average price for some of these assets are around that sort of $4, $5, $6 million. So pretty cheap compared to a lot of other commercial property out there. But of course, there is such an increase in population, as Taylor just mentioned, that these centres or these franchises are likely to be frequented more so in the next couple of years. But also Australians do have a love for fast food as well, and everyone seems to love chicken. KFC and Red Rooster were the two most popular fast food franchises. So it is a bit of an interesting one, and it's certainly something to watch over the next couple of years to see how that does develop. And at this stage, it does appear that it's mostly private investors that are buying these assets. We haven't seen a lot of institutional investment, but that may change in the next few years, and you might start to see investors piling into the fast food franchise sector. And for those of you with keen eyes and a love for McDonald's, yes, these are the Macca's Red and Macca's Yellow. Now, speaking of private investors, they do remain the most active players in the market, mostly because of their opportunistic tendencies, and they tend to be a bit more active during periods of economic flux. They're just a bit more nimble, a bit more opportunistic. They tend to buy outside of cycles, and that's certainly what we've seen so far in the last 2 years or so. History tends to repeat itself, I find, in the property market, and this is no different. Private buyers were the most active during COVID, and private buyers were the most active during the GFC. So they continue this trend. Again, it speaks to that more opportunistic mindset they have, and slightly easier to get deals across the line as well. They don't have to adhere to ICs or limited ICs and limited shareholders, and therefore they're a bit more nimble. No real surprise, it's the REITs that are selling more than they're buying, and that's what this chart is showing here. The orange box is just the net position, so difference between buying and selling. They're big sellers. They're paying down debt, and they need to raise capital to pay down these debts. So they're far more active in the selling market and not so much buying. Now, in terms of offshore capital, it's been very quiet this year. Normally, offshore players account for around sort of 30% of all transactions in the market. This year, they're sitting around the sort of 22, 23, so pretty low. Perhaps they just see a little bit more relative value overseas as those values have adjusted a bit faster than Australia. But of the investors that have come to Australia this year, Hong Kong, surprisingly, actually has secured its spot as the leading source of capital, at least in the last quarter. PAG from Asia acquired a couple of large assets of 44 Market Street, for example, and Midland Gate Shopping Centre in Perth. But it's actually Japan who is the number one source of capital so far this year, thanks to a couple of build-to-rent acquisitions. This is absolutely no surprise to me. I said Japan will be the leading source about 3 years ago. When the market slows down in Australia, we start to see Japanese investors come into the market because they're the ones that can make those really slim returns stack up. So they tend to increase their allocations to Australia towards the end of the cycle. Now, Singaporean investors is usually our number one source of capital, along with the US. They kind of duke it out for number one and number two. But Singaporean investors have only allocated around 800 million to Australia so far this year, which is very low for them. It's about a 90% decrease on last year. I think the predominant reason for that is they generally just target office assets, and office acquisitions, for obvious reasons, are a little bit of a struggle at the moment to get to stack up. So we've seen limited investment in that space. And we can really see that here. This is just looking at offshore sector activity, so where they're buying and where they're selling. I'll start on the right-hand side. Whilst hotels still are quite popular with a lot of people, it's such a small sector. This negative net position has just really been driven by one sale. So I don't think that's particularly indicative of the market as a whole or offshore investors' appetite for hotels. But the interesting one for me is commercial residential. So what I mean by this is purpose-built student accommodation and built-to-rent assets. Now, we've been tracking this for 23 years, and every single year, the office sector has been the main sector for offshore acquisitions. And it doesn't look like it's even going to come in the top 3 this year. So that is a fascinating change and really speaks to the troubles that the office sector does have at the moment. But I would really like to see if it was if the commercial residential sector actually was the #1 sector for offshore investors. I think that would be a real shot in the arm for the build-to-rent sector. Now, of course, pricing has been one of the biggest sticking points in this current downturn, and it's largely behind the remarkably low transaction volumes that we've seen this year. And a big reason for that is obviously the vast chasm between buyer and seller expectations, which I'll get to in a second. But I just wanted to show how some yields have actually changed over the last 12 months, because there's some interesting stories. I'll start at the bottom and pile into the poor old office sector. That has seen the most expansion in yields. Both CBD and suburban offices are kind of trading at around that around the 6% mark at the moment, both up sort of 60-70 bips. 70 bips for suburban and around 55 bips for CBD offices. So quite a substantial increase in yields. No huge surprise. Pubs is an interesting one, actually. I'll talk about that for a sec. So pubs has seen around $9 billion worth of transactions in the last few years. That's a heck of a lot. But we've seen prices actually come down for pub assets, therefore pushing out those yields. Bit of a surprise there, because I thought they would continue to compress, but I guess prices adjusted very quickly in that sector. People's disposable incomes obviously significantly reduced, as Taylor just alluded to before. And looking at those retail ones, again, we've seen the biggest expansion in yields across those larger shopping centres. Now, hotels have actually seen yield compression, but full disclosure, this is more or less a rounding error. But again, any reversal of trend is quite noteworthy at the moment, because as you can see from this chart, everything's expanding. Now, industrial is a funny old one. We actually only saw 1 quarter of yield expansion in industrial, and we've seen 3 consecutive quarters of yield compression in the industrial sector. Yeah, I do find that quite surprising. I know vacancy is very tight, stock is very limited, but most of the industrial acquisitions is kind of predicated on online retail, and online retail is driven by discretionary spending, and obviously discretionary spending has deteriorated. So I'm a little bit surprised that people are having to pay over book value. And this is a kind of a trend we're seeing globally as well. So we have a piece of analysis called price expectations gap, and this is just looking at global averages by sector. So it was a theory that was developed by MIT and put into practice by us. Now, I've left the methodology on there, so when you get a copy of the slide, you can read through that at your leisure. But the idea is that the result of this is the magnitude of price change required to restore liquidity to long-run averages. And by liquidity, I mean transaction volumes. So this is what prices need to adjust by in order for buyers and sellers in order for transactions to start moving again. Now, effectively, you can halve this because you're assuming that people kind of meet in the middle. So the average gap between buyer and sellers for the office market globally is around 16%, meaning that we kind of expect to see an 8% fall in the value of offices globally. And again, no real surprise that the office sector is the worst performing sector. And that can really be seen in this next chart. All I've done here is I've just ranked the 143 markets that we cover. And the purple is the office sector, red retail, orange commercial resi, and of course green is industrial. Now, there's a heck of a lot of purple towards the right-hand side. And you do the 5 worst markets are all in the office sector. And you can see Australia office there is pretty low. We're expecting a gap there is around 20%. So therefore, we're kind of implying that we're going to see a further 10% drop in values for the office sector. But if you look at Sydney industrial, it would appear that buyers are having to pay a premium in order to secure industrial assets in Sydney. And again, that kind of speaks to what we've seen with pricing, given that the last 3 quarters, we've seen yield compression, meaning that indeed investors are paying above book value in order to secure these assets. So just to put this into practice, because of course this is a bit more of a theory. So this chart shows how these sectors' valuations have adjusted over the last 12 months according to our direct property index. Now, most of them, of course, have been declining, except the industrial market, naturally. Now, again, if we assume that buyers and sellers meet in the middle, i.e. we halve that gap, then we can expect from Melbourne, for example, that office prices need to adjust by another 9.7% and Sydney a further 7.7% before we'll start to see transactional activity. Now, of course, transactional activity and prices dictates almost solely value. Values will use transactions to put a price or to put a value on assets. Not completely dictate, but it forms a major portion of it. So I'm not overly surprised to see that we need to see further declines in valuations. If we look at our index results, again, we don't really forecast, I'm not allowed to forecast, but I can certainly read a trend. If a line is sharply declining, I don't see that reversing anytime soon. So I would expect to see further declines in office values. And now, look, does this seem plausible? For me, it does, yes. And if we compare these total value changes to what we saw in the GFC, then on the whole, yes, I would expect to see further, I would expect these numbers to play out from what we've seen in the price expectations gap indicator. Obviously, the exception here is industrial. I don't think we'll see GFC declines like we saw, for industrial during the GFC. But if we look at what has happened in Sydney office, the current value change, our price expectations gap indicator change, it's pretty much bang on the GFC. The question is, are we going to see values, offices perform worse than the GFC? I think that's what everyone's asking at the moment. And look, this is looking at GFC peak to trough and what we've seen so far in this current downturn. We've got a long way to go to hit those GFC levels. I hope we don't, but I would expect to see another 12 months of price moderation before we start to see a bit of a recovery. And no real surprise that we are seeing a bit of a flight to quality. Prime office values are generally hold up a heck of a lot better than secondary offices. So I do expect to see further declines in the secondary office space. In terms of overall markets, look, Sydney will always fall first, so it has fallen pretty substantially, more than any other market. Melbourne closely followed, and Brisbane and Perth, look, they've held up pretty well during this current slowdown. But for me, it really is that secondary office that it is a bit of a concern. And this is looking at what that recovery might look like for secondary offices. Now, what we're looking here is just how long it took values to recover to their pre-GFC peak, and also the value change so far this downturn. I have noticed that nobody's actually named this current downturn, so I've just kind of combined COVID and inflation and just called it coflation for the sake of this chart. If anybody has a better name, please shoot me an email. Now, it took secondary offices a heck of a long time to recoup their values that they lost during the GFC, around sort of 9 years. And so far, what we've seen in the secondary market is a very similar trend. So that red line and that purple line look very similar to me. So I would expect to see another 12 months worth of value declines for secondary offices, and then for them to take a considerably long time to get back to levels we saw last year or even 2 years ago, effectively. Now, just to finish up, it's always good to compare ourselves to other markets. And I normally do this so we can crow about how great Australia is, but for once I can't do that. We're actually one of the worst performing markets in terms of transaction volumes. Other global markets have performed significantly better than us. Now, there is a lot of debate as to why this is. Do overseas investors, for one, see better relative value in overseas markets? Potentially, but overseas markets are still performing pretty badly anyway. The other big part of this is, of course, I think around 55% of our direct property index is office. So the vast majority of the commercial real estate sector is office, and nobody's buying offices. So that's a big reason why we're seeing such a heavy decline in overall transaction volumes. Whereas if you look at the US and the UK, industrial sector makes up the majority of those markets. Now, if you cast your memories back to COVID, there was a lot of discussion about what the recovery profile is going to look like. Will it be a Nike swoosh? Will it be a W, an N, a flying V? I think there's a Z thrown in there for some reason as well. I don't know what the recovery profile is going to look like, but looking at some of our global counterparts, most of those scenarios are actually out in play. The US is looking like a bit of a Nike swoosh, Netherlands Nike swoosh, Canada was a flying V, the UK was a sharp V, and Ireland looks like a bit of a double dip. Australia, our major valuation quarters are June and December, so we normally see a bit of a flattening or an uptick in Q1 and Q3. So I would expect to see a further reversal of this, and to see total returns actually fall in December, meaning we could almost say that Australia is going to see that dreaded double dip. How it recovers next year, I think, is the question on everyone's minds. I'm sure there's a couple of questions in the chat about that. So thank you for your time, everyone. I'll pass back.
Thanks, Ben. Taylor. So the first question in the chat is around office vacancy. So Ben, given that you have been speaking about office, do you just want to make some comments on vacancy, and also perhaps just expanding on your secondary office comments, you know, like what else could we do with those offices if vacancy is not recoverable?
Yeah, it's a good question. Our vacancy is pretty high in most markets. I think Sydney and Melbourne are still well above long-term averages, or sort of double long-term averages. But yeah, to your point, I think vacancy it's not redundant at all, but you need to break it down by grade. I feel secondary vacancy is very high. It's always much higher, but in periods like this, it is significantly higher because you can get better lease agreements or better rental agreements by moving around, and you can certainly argue for better terms. And so we're seeing a lot of tenants go to better quality assets. So yeah, everyone's asking what do we do with secondary offices. I know there's a lot of chatter about let's convert them to resi and solve the housing crisis. I mean, I hope that works. I doubt it. It's very expensive, and every other day you're seeing residential developers go into liquidation. So why would you want to get into that game? I know there are some that are doing that, but it's extraordinarily difficult to make those projects stack up. So if we do see any secondary office conversions, I think it'll be minimal, and they are going to be very expensive. I mean, one thing I have been talking about recently, and people are asking me about, is do we need to convert secondary offices to something else? I mean, yes, I'm sure we have too much secondary stock for sure. That's not going to get filled with this whole working from home thing, but people are they're downsizing space. They're not necessarily downgrading quality. So there are opportunities for boutique offices, you know, those 5, 6, 7, 10 floors to be converted into really high quality office space. Then you might get some tenants moving into, again, still a similar quality to a premium building, just less space. And again, I think that's an important thing for people to realize. It's not the downgrading of quality necessarily, it's a downgrading of size that is the issue at the moment. So there's an opportunity, therefore, to pick up some of these secondary offices that are trading at significant discounts, and then maybe taking them off the market and fitting them up, hitting better ESG standards, and also putting some more quality fittings in there. And then you might see an uptick in tenancy. Again, just a theory. We'll see if it happens.
Thanks, Ben. Taylor, there's a couple of here for you. So just keen to understand the view of inflationary pressures from Australia's excessive savings, and then migration levels and tax cuts from July next year.
Thanks, Michelle. Yeah, I think all three of those things are, something that, certainly is why we think that we're still framing the consumer as broadly resilient. So there's a lot of headwinds out there, high inflation first among them, raising interest rates, but there are tailwinds in the backdrop as well. And so these are three of them. I touched on migration as a key support to consumption over the past year. That will keep supporting. I think when we think about the inflationary impacts, it's not all one-sided. Immigration isn't just adding to demand; it is supporting supply as well. Michelle Bullock has been making this point. What it is doing is easing some of those acute labour shortages that we saw in the labour market. The amount of people available to do work is adding to capacity to meet that demand as well. In certain pockets, think hospitality, think tourism, agriculture, where the key source of some of this migration is easing labour market shortages even more rapidly there. And so that's helping ease some capacity constraints, easing some of those pressures as well. Where it's unequivocally inflationary is coming in through the housing side, where there just isn't that elasticity for supply to respond in the short term, even as this is adding to demand. So that is a key support. In terms of the excess savings buffers, Australia, as we've seen in a lot of other countries, but even more so importantly, depending on your estimates, up to $300 billion or so. About 20% of annual income sitting in extra savings buffers that have been accrued over the pandemic. What we're seeing at the moment is that they are slowly being worked down. The amount of income saved is lower than it was prior to the pandemic, but they're not being drawn down rapidly. They've been drawn down for not as long as we've seen in the US so far, and they're still very, very high. So that is a key support as well. We're seeing that with why part of the reason why mortgage stress levels have remained really low. There's a lot of savings buffers through there as well. I think a broader point there is we don't expect this to go back down to zero. A lot of this sits with higher income earners. A lot of it will just be banked as a positive wealth shock that doesn't necessarily have to show up in consumption, but it certainly is a tailwind, just as income tax cuts through from mid 2024 are. So just to put some context around that, it's about $20 billion worth of tax cuts that flow through. That's close to 1% of household income. So this is a large number. But I spoke before about how much higher income tax is dragging on household income at the moment. So I guess another way to look at it is this is just giving back to the household sector as a whole, the increase in income tax that we've seen over the last couple of years due to bracket creep, due to higher employment. The other thing there is that where it falls distributionally, less of it is likely to be spent with those higher income earners where a lot of these tax cuts end up, tending to consume more of their consume less of their marginal income than the aggregates. All of that is to say, directionally, each of these things are, they're adding to resilience in the economy. They're adding to demand. They probably are inflationary, but they're in the context of the headwinds that we're seeing. Monetary policy is restrictive. They're all kind of in the forecasts. But these are reasons, I think, when we look at our forecasts, we think the risks are still to more from the RBA, and we think that they won't be in a position to cut for some time because there are things on the other side that are supporting activity, supporting inflation as well.
All right, thank you. Ben, I'll go back to you. There's a couple of questions here just asking about medical assets. Do you have a bit of a view on those for us, please?
Yeah, the whole life sciences sort of area. Obviously population growth booming in Australia. There's a lot of appetite for medical centres and hospitals and all types of healthcare assets. Hospitals were actually the only subsector that we cover that saw an increase in transaction volumes compared to last year, the only one. There's significant appetite for healthcare assets out there. And my standard joke is always, I've never seen the headline saying we have too much healthcare. So we're always going to need more and more healthcare. And because it's such a limited sector, there's a lot of FOMO, fear of missing out when some of these assets do come up for sale. So pricing has remained pretty robust. And in terms of overall performance, look, on a long-term basis, it's second only to industrial. And industrial's only really been booming in the last sort of 5 years or so. So healthcare is definitely at the topmost of investor mindset. I saw in the chat, there's another question on healthcare yields. I think about 3 or 4 years ago, I put a chart showing the spread between office, retail, industrial, and healthcare. So 3 years ago, retail was the tightest trading sector we had in Australia. Now, industrial took that down. And then, office was the second most, industrial took that down. Then retail, which was the tightest, industrial took that down. And healthcare has been doing the same thing. And I kind of made a bit of a question / prediction 18 months ago saying, will healthcare take down industrial? Potentially. So healthcare yields are around the 4.8 mark at the moment. That's increased from sort of 4.5, 4.6 12 months ago. Industrial, similarly, was around 4% 12, 18 months ago. It's at 4.75, and those yields are increasing much faster than healthcare. So I will fully expect, therefore, that either end of this year or early next year for healthcare to be the tightest trading asset class in Australia. So yes, lots of appetite for healthcare, and I don't see that abating anytime soon. And of course, with everyone going to fast food places, arguably we might need more healthcare.
Yeah, I do think that might be the case. Taylor, just in, we don't have a lot of time left, just in a minute, can you cover off your expectations around the housing market, please?
Certainly, yeah. Look, very briefly, I think, we've talked about some of the themes in higher interest rates, affordability squeeze coming from that, offset by the strength of demand. We've seen both from the demand for space that we've seen from individuals, and then also the rapid increase in population that we've seen. At the moment, I think what we're seeing is that housing costs in general are going up, rents are increasing, that outside option compared to buying is supporting as well. And so people are just dedicating more money towards housing in order to get hold of that space. And that's been a key support and an offset to that affordability constraint that is more binding. When we look forward, we don't think that the current pace of growth is going to be sustained. If we look over 2024, we think nationwide resi property will continue to grow, but slow to something like 5% over the year. And then further out, we think that the balance will probably shift. There's a lot of uncertainty that far out, but we think something that looks more like stability. With that, we think we will be seeing a reduction in interest rates at that point, but only a modest one. So that we'll be seeing some of that affordability constraint ease a little bit, which is a support. But yeah, we don't think that the current pace of growth will sustain.
Great. Thanks, Taylor. So we'll have to leave it there. I hope that you found today's webinar informative. Thank you so much for dialing in. And thank you again to our presenters, Ben and Taylor, for really informative presentations, which will be shared afterwards. For our customers on the line, I'd really like to take the opportunity to thank you for your custom. We do really value your business, and we look forward to continuing to partnering with you with your ongoing opportunities. If you do have any questions or concerns, please contact your banker. If you'd like to explore any interest rate strategies, we can put you in touch with our market specialists. And I'd also just like to take the opportunity to wish everyone a really happy festive season, and I hope you get a great break over the new year. And we'll look forward to restarting these webinar series in February. You will receive a survey as the webinar closes. We would appreciate it if you take the time to provide us with some feedback, and also particularly to provide any suggestions for topics for future. We just want to make sure that we're providing relevant information to you. So thank you and goodbye. Enjoy your day.